The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 of Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. We're about 10 minutes away from the closing bell. And what a rally we have underway here. The S&P is up by 1.2%. Scarlett, this is the best S&P rally for a Fed day since 2022. And it's across the board. Look at the Russell. Look at Mag 7. Look at the equal weighted index.
Look at yields. They've come way down. You have the 2-year yield down about 6 basis points. The big question is, what was so bullish? What was so dovish about the news conference?
We were trying to debate this too. Like, was it Goldilocks? Is it because there were no cuts, no hikes, and it was a Goldilocks scenario, even though you had growth downgraded and inflation upgraded? Is this
and unemployment upgraded as well?
Exactly. Or is this like an oversold bounce? Or is this just like there's been no bad headlines in the last 24 hours?
Maybe all of the above, and the fact that Jay Powell sounded fairly calm, sounded kind of reassuring.
And he's just as clueless as everyone else. Maybe there was like power in numbers when it came to that to the end of the day.
All right, well, here's a brief taste of what Fed Chair Jay Powell said in the last hour.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Transitory. That's back, I guess. All right, for more market analysis, let's welcome Ken Shinoda. He is a portfolio manager at Doubleline, and he joins us in studio today. So, Ken, let's get to what we were just posing the question as, which is stocks added to gains, bond yields fell, gold prices rose, the dollar pared its gain. That was after the 2 p.m. decision. And then during the news conference, we saw more of the same. Why is the market seemingly relieved?
Well, I think stocks were very oversold. We've been seeing equity sell off for over 2 weeks. If you look at investor sentiment surveys, they were as negative as they were in October of 22, right, when stocks were down 20%. So we were overdue for a bounce, and Powell went straight down the middle of the fairway. And I think it was a little more dovish than people expected. He noted that, inflation is still a risk, but he didn't say that they would hike if inflation stayed persistent. He said that they would hold rates at the levels they are today, and if growth comes in slower, they have the ability to cut. And I think that caused a little bit of rally in fixed income, and it's going to help equities bounce for maybe a couple weeks here.
A couple weeks of bounce. Okay. What did you make of the fact that the transitory word was brought up again? What kind of confidence does that give you in where we're going here?
They just love to pick on him with the transitory.
I know. Well, to be fair, he was calling it tariff inflation, and then there was a couple of words of transitory, but it feels like tariff inflation is transitory now. And
we saw that with the last Trump administration. We saw a tariffs pick up in inflation on a one-time basis. But tariffs are deflationary globally in the sense that it can slow growth, and that's what the market's sniffing out right now.
So tariffs themselves may be transitory once they're put in, but what about constant threats of on-off tariffs that may persist over time, including over the next, 3 years and 10 months?
It's creating uncertainty for consumers. It's creating uncertainty for businesses, and that's one of the risks that's out there that could cause an economic slowdown, is that companies with this uncertainty, we'll pull back on capital investments, we'll pull back on hiring, and so on and so forth.
There was also a lot of talk, a lot of time spent on the decision to slow down the balance sheet runoff, and how that was tied to the decision to, not decision, but the whole debt ceiling, confrontation we'll have later on this year. Is this the equivalent to a stealth rate cut in any way, or is this just something very technical?
Look, I think they're worried about potentially having some of those liquidity problems that we saw pick up in kind of like 2018 and 19.
The overnight funding markets.
Yep. So I think just kind of getting ahead of that, and we'll see how that goes.
What do you like right now in the market? After all this is done, what do you like?
Look, I think European equities, they've had a great run. I think that the valuations are cheap there, and they're going to stimulate. So I think there's more room to run there. And then on the fixed income side, I think the risk of, going back to that kind of like 4.75% on the 10-year has diminished. It's pretty amazing. I mean, we were at 4.70 on the 10-year not so long ago. Yeah. And we had some calls from investors for, 5% rate, 6% 10-year.
Yeah.
Where's it going to stop? Fiscal concerns. Fiscal concerns have seemed to have gone away. And I think part of that is because of this kind of slower growth narrative that's coming in the marketplace. So I think the longer end of the curve, I don't love the long bond, but I think longer duration, the risks to that upside have diminished. So if you get a backup in the 10-year back towards 450, I think that's a decent buying opportunity. We've been going up the credit curve over the last couple kind of months just because the credit curve was so flat. So you weren't getting paid as much spread to go from investment grade to high yield, for example. But spreads are starting to widen. So if vol kind of stays elevated and you see some spread widening, you can maybe get some opportunities in the credit markets too.
To that point, when you're talking about European flows, and we have seen money kind of move in there, does that come at the expense at some point of U.S. credit? And does that kind of move into other areas of the European market, for example?
It's one of the things we talk a lot about at Doubleline is capital flows. And we've had this huge run of money coming into the U.S. Reserve currency being the U.S. dollar and a lot of central banks buying U.S. assets, sovereign wealth funds outside the U.S. buying U.S. stocks. And what if that reverses? And I think a lot of that is in the equity market. You're already seeing some of that. But it could happen in bonds too. The good news for bonds is that foreign investment has been decreasing for years now. So I think it's less of a problem for the fixed income market.
In a world where nobody knows anything, and I think Jay Powell made that pretty clear when he said, 2 rate cuts, why not? What are the near certainties that investors like you can work with?
I think that we know that the bond market seems to be kind of fairly valued right now, I think. I think, most estimates by research people out there is calling for like a 425, 450 10-year at the end of the year. So I think there's a lot more certainty in fixed income than there's in equities. I mean, we've seen the reset in fixed income has been a rough couple of years, right? Yeah. So I would just be cautious on risky credit. You're already seeing this market start to kind of sniff out some concerns with like CCC, junk bonds and things like that, and spreads are widening there. But, people that have been underweight fixed income, it's probably not a bad time to start adding.
Ken, such a pleasure. Good to have you in studio. Thank you so much for joining Ken Shinoda over at Doubleline. Joining us there, we are holding on to the gains in this rally. Scarlett, the Nasdaq up by 1.4%, the S&P up 1% as well. You're definitely seeing buying within the bond market, yields dropping, particularly in that front end, and gold still at a record. So that dynamic, so interesting. And
when you look at the equity markets, all 11 industry groups are higher, although the laggards here are the ones that have done very well, all the defensive sectors, right? The healthcare, consumer staples, real estate investment trusts are all up by less than 0.1%, but still in the green.
And to that point, Mag 7 doing really well on no Mag 7-y kind of news, so clearly that oversold bounce as well. And Citi called it. They're like, we're going to see a 1.2% move on the S&P either way. It looks like we're kind of hitting that level right now. We are moving to the closing bell on this Fed Wednesday. We have full market coverage for you right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Alex Steele and Scarlett Fu taking you through the closing bell in a global simulcast. We're joined now by Scarlett Masser and Tim Stenovic, bringing together our Bloomberg Television. What are you laughing at me?
Scarlett Masser, love it.
I said Carl Masser?
I would gladly be part of your family.
Did I say that?
Maybe I heard wrong. I'm egotistical like that.
Okay, I definitely could have said that. I didn't have my best day on radio today. We're going to take you through the closing bell and all the pivotal key moments on radio and YouTube and TV in a global simulcast.
There you go.
Well, whatever. Anyway, there was a rally, guys. It's the best day for the S&P on a Fed day since 2022. Whew.
I know. It's kind of interesting. I love the commentary. A little bit hawkish. Is it a little bit dovish? I mean, equity markets definitely moved up higher on it. We saw yields back off. As we were just kidding with Ira Jersey in our conversation, I'm already looking forward to the May meeting to see kind of where the Fed goes. A lot to get to, though, before we get there.
Still off our best sessions, our best levels of the day. Interesting to see this, at least equity market reaction, given the uncertainty that Jay Powell communicated during the press conference. It doesn't seem like he really understands or knows where the economy is or where it's going. Mike McKee said as much post-press conference.
Yeah, my takeaway from this news conference, even though he sounded really reassuring, he looked really reassuring, was that nobody knows anything. They don't know. They don't have a clue. In the same way that perhaps the president himself is not quite sure what he's going to do next.
What I did find interesting is that he finally sort of walked through what would make this tariff headlines become less noise, and that's that housing services inflation, not through goods, not the non-housing services inflation, but very specifically, this is something to definitely watch. gosh. All right, there we go. We are wrapping up the closing bell on this Fed Wednesday. S&P up by a full 1 percentage point. The best day for the S&P on a Fed day since 2022. The Dow following suit up by about 1%. And the NASDAQ outperforming up by 1.5%. Guys, it's broad, equal weighted, mid cap and small caps.
Gotta love that. Just digging a little bit deeper into the S&P 500. Most names in the index higher today, guys. 367 actually gaining some ground. 133 to the downside. 3 Scarlet unchanged.
All right, and the relief in equities, you see it across the board here. Let's look at the IMAP, which splits up the S&P 500 into 11 groups, all green. Although it should be noted that the defensive sectors, healthcare, real estate, consumer staples, utilities, those are the laggards. They've gained the least. In fact, those 3 groups, staples, real estate, and healthcare, basically unchanged to up 0.1%.
And they were just getting going. All right, so much for that. All right, let's get to some of the individual gainers. Boeing, guys, number one gainer in the S&P 500, a gain just shy of 7%. Company came out, said cash outflows are likely to be smaller than forecast this quarter, with cash burn, quote, could be in the hundreds of millions of dollars, better than expected. They went on to talk about their factory operations stabilizing, production of the 737 going pretty well, and a shadow factory for finishing mostly built 737s likely to be wound down this summer. So some good news out of certainly a company name that has been really pummeled for a while. Taking a look at Roku, up about 7%, up as much as 10% earlier in the session, but still finishing with a gain of more than 7%. This stock jumping after Trump Media and Technology Group launched its Truth Plus streaming app on the Roku channel store. And I should point out, this is despite Guggenheim coming out and cutting its price target to $100 a share from 115, stock closing at around 72 a share. One more for you. Signet Jewelers, man, on a tear, up nearly 25% at its highs today, finishing with a 17% gain. The owner of K Jewelers touting a solid start to the fiscal first quarter, issued an annual outlook that Citi's analysts described as better than the market feared. You might remember, company had a tough time the holiday season. It was pretty weak. That led Wall Street to slash expectations for the company. Company does, though, say sales are rebounding after that weak holiday season. Stock, though, Tim, still down about 30% year to date.
Hey, guys, I just want to jump in real quick, though, because Five Below is out with earnings, and that's always a fun one to look at, Tim. So we're looking at the full year for forecast for net sales, actually coming in pretty well. You're looking at the high end, about $4.33 billion. And on earnings, you're looking at about $4.52 a share on the high end. All of that, at least on the net sales, that beat estimates. The earnings fell a little bit short. For the first quarter, though, same thing. It seems a pretty solid quarter for net sales as well as EPS. Five Below, though, it's like it has all that cheaper stuff. I definitely go there to shop for my daughter's birthday. So it's going to be interesting to see sort of what they say on tariffs on the call.
All right, Five Below shares kind of bouncing around a little bit in the after hours. I do want to get to some of the decliners in today's session. Intel actually snapped its 5-day winning streak, falling by 7% today. This after a TSMC board member dismissed a report that TSMC had pitched to major U.S. chip makers about taking stakes in a joint venture that would operate Intel's factories. We're talking about Liu Qin-Cheng, the minister of Taiwan's National Development Council, also a board member at TSMC, said that he could state, quote, with certainty that the TSMC board has never discussed a collaboration between TSMC and Intel. This is according to a report by Taiwan's official Central News Agency. Still, Intel shares up 20% so far this year. I'm also watching what's going on in one pharmaceutical company, Gilead. Shares falling today by 2.5%. This after the Wall Street Journal reported that the U.S. Department of Health and Human Services is weighing plans to cut federal government funding for domestic HIV funding, citing unidentified people familiar with the matter. Analysts said that while the headlines were negative for Gilead, there wouldn't be too great of a hit because the potential cuts wouldn't impact access to those drugs. Gilead does make drugs that prevent and treat HIV, such as Truvada and Descovy. And finally, General Mills shares fell today. The company did report third quarter organic sales declined by more than expected. Shares fell by 2%. It's yet another a sign that the slowing consumer spending is happening in the U.S. The company, Alex, also cutting its full year forecast and its organic net sales forecast for the full year.
So is it Gilead or Gilead? Just asking.
I don't know.
We don't know.
I said Gilead.
I think it's.
I said Gilead.
Is it Scarlet Masser?
Oh, shade has been thrown.
Yeah.
I receive that. I accept that shade.
Wow.
That was great. Especially if I didn't even know I said it.
San Francisco has not softened him, huh?
No, it just hardened them up there.
Yeah.
Still the techie stuff.
He's a mean New Yorker in San Francisco.
He's a mean New Yorker.
Everybody here is smiling all the time.
He's from California, guys.
Yeah, but he's lived here for long.
Now he's in Park Slope, where all the mean people live. All right, taking a look at the bond market, guys. It's a bit across the board, particularly in the front end. You have yields down by about 6 basis points. I mean, it's hard to make a lot out of this action, right? I mean, is it just removal of the bad news? We're removing any risks of a rate hike. We're also not seeing an economy that falls off the cliff. Like Jay Powell, clearly still optimistic about the state of the economy despite the risks. But take that for what you will. Also, positioning has been quite different also.
All right, guys. Now that the Fed meeting is over, I think it's time for us to go on a road trip, a little class trip of this simulcast, and go to Denny's because they've got a new breakfast offering, limited time only, the NVIDIA breakfast bite. And it's about 4 sausages. You wrap it around a pancake, dip it in syrup, and Tim, right? It's just like Jensen liked it.
Wait.
Yeah, remember, you guys know this, right? The origin story for NVIDIA apparently happened in a Denny's in Silicon Valley.
No,
so
tell us.
Denny's for years has been really harking back to that moment.
Or milking it.
For promotional materials. And this is no exception, especially during NVIDIA's GTC week. You can see Jensen there at Denny's flipping some pancakes.
So this is their newest collab with Jensen Huang? Like, it went from like social media influencers to Jensen Huang?
I don't know if Jensen, I don't know to what extent NVIDIA, I don't know.
It did happen at the GTC conference,
look,
and there are no chips in them, like
and he did say
Blackwell chips
in the
or
press
anything.
release. In the press release, he said, Denny's will always be a special place for me. It's where I learned that no task was too small to do well.
Wait, refresh. So what is it? It's sausage.
4 sausages. You can wrap it in Denny's buttermilk silver dollar pancakes. Then you can dip it in some syrup.
Yeah,
Totally
yeah.
healthy.
All right, I'm into that. But
I'm into
it's
that.
interesting that it's called the NVIDIA Breakfast Bites, BYTES.
Right.
BYTES.
Nice. Okay.
All right, the other story that we're paying attention to.
Are you going to be serious?
Yes, I am.
I'm sorry. The story's cool.
Well, we were excited about this morning when we saw it, which is Oppenheimer downgrading Goldman Sachs, Carlyle, and Jefferies because they're saying that the anticipated boom in M&A has not materialized and may never materialize. Now that it's pretty clear President Trump is really pursuing tariffs as opposed to some of the other let's just say loosening of regulation that a lot of people had anticipated.
Right, the phase 2, which would be lower taxes, as well as the deregulation. I appreciate this is not like a fun chat, but the idea that we're waiting for this M&A for a while and the animal spirits, if it doesn't materialize, not just pushed out, but doesn't materialize, like isn't that a big re-rating of what we need to think about?
Listen, these private equity guys. Oh, sorry, go ahead, Tim.
Yeah. Well, what about the $32 billion Google Wiz acquisition that was announced?
That's reviving something that they were looking into. That's number one.
Yeah, but
nice
they were reviving
premium.
it. One of the reasons they were reviving it is because a regulatory environment that might be friendlier, right?
But no one can plan ahead right now because nobody knows what's going to happen, right? Nobody knows anything. Yields are kind of all over the place, right? And nobody knows what the environment's going to be like. So they're all just like, oh, I'm paralyzed. I got to wait to see what happens.
Yeah, I was going to say, like all the private equity guys. I mean, M&A bankers have been waiting for Trump to be in the White House, thinking everything was going to be easier. We're going to get deals done. And then all of a sudden, it's like all this volatility and nobody wants to do anything. So, yeah, it is. All right, it's a good story.
It is a good story. We've been kind of waiting for the first
story.
for the first thing to fall. And it feels like this is it. This is the first downgrade here.
No, it's a really good point. And we'll see certainly when we get into the next earnings season, right? Like what the context is and the commentary. All right, guys, we are going to do this road trip. I could totally see us all getting into this sandwich.
NVIDIA Breakfast Bites, here we come.
All right, that's a wrap. Across platform on radio, TV, YouTube, and Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
All right, coming up, we're going to continue the conversation on what's next for the Federal Reserve with Betsy Duke. She's a former Fed governor and the former chair of Wells Fargo. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. Guys, really crazy market today. The best day for the S&P on a Fed day since 2022. Tech really outperforming. Everything that was hit pretty hard is now excelling. You also had a move into the bond market, particularly in the front end, and gold. It felt like it was like just buy all the U.S. stuff. versus U.S. stuff is a no-go right now.
Yeah, risk assets get a big bid, but so did gold. So that's a really interesting, situation here where risk on and also the safest haven on too. Let's take a look at some individual movers on the day. The best performer in the Dow Industrials was Boeing after its CFO spoke at a conference saying that cash outflows will likely be smaller than forecast as it continues to stabilize work in factories and clears out its inventory. Gilead Sciences down about 2.5%, biggest drop in 4 months. According to the Journal, the Health and Human Services Department may cut federal funding for domestic HIV funding. So that's a bad headline, but still, analysts say that won't be too great of a hit because the potential cuts would not impact access to those drugs.
All right, well, let's get more back into the Fed here. The takeaway was that still 9 policymakers penciled in 2 cuts, but there were no dots that signified any hikes. And that kind of relieved some of the stress within the market. The real question is, when does the noise turn to signal, and when are there economic fundamentals that then the Fed can trust? Betsy Duke is former Fed governor and former chair at Wells Fargo. She joins us now. Betsy, give us your grade. How did Jay Powell do? How do you think it went?
Yeah, he did as well as he possibly could have. I mean, he was getting dinged a little bit about uncertainty at the Fed, but you have to figure if businesses are uncertain, consumers are uncertain, investors are uncertain, and forecasters are uncertain, the Fed's going to be uncertain.
Yeah, so the Fed's going to be uncertain, and he kind of made that clear, too, when pressed on why they stuck with the 2 rate cuts for this year. It's kind of like, well, what else are you going to do when we're not sure what's going to happen? That being the case, what's the data point that matters the most going forward right now?
I think the data point is going to be, if you listen to his initial comments, he called out, the thing that was important to me was he called out policy on trade, immigration, fiscal and regulatory policy. So right now, there's a lot of focus on trade policy and tariffs, and that could move forward and have one effect on the economy. And if the Fed reacts only to that, and then you turn around and you have huge fiscal stimulus coming in 2 or 3 months later, then that would tend to push the Fed in the other direction. So I think holding steady where they are and continuing to watch what's going on and how the policies are developing and being rolled out is the way for them to go.
That's such a great point, because we were just talking about how the animal spirits were supposed to ignite all this M&A and capital market activity, but because we haven't gotten to the phase 2 of lower taxes and deregulation, we haven't seen that. Do we think we get there?
I think you do. One way or another. You either get there because they come to fruition, or you get there because it becomes obvious that it's not going to happen. And so either way, you begin to get clarity as you move forward. And so, when Jay talks about being in a good place, so policy is not in a place where it really needs to move. I go through the exercise of writing down what I would write down if I were still on the committee. And I'm not sure, I was still stuck on, do you put down 1 cut or 2 cuts? That was about as far as I could go. When I look at where the median dots went, they had growth coming in lower, but it was still right at potential. Unemployment ticked up just a tick, and inflation was higher than they had forecast, but no higher than it is today. So, all in all, it did look like a case for continuing to be patient.
Right. A lot of wait and see. Now, Alex mentioned phase 2 of the policy from the Trump administration, deregulation, M&A, tax cuts. The Trump administration itself has signaled that they see this happening in the second half. Does that sound feasible to you, Betsy, in terms of the Fed being able to, hold off and not do anything until then to see that take off in the economy?
I think so, because I think, particularly on the tariff piece, I mean, immigration is pretty much at this point, you can see the direction it's going, and the real question there is what are the courts going to do? But on trade, if things got really out of whack, the administration is in a position to act faster than the Fed.
Okay. That's interesting. And also more reactionary, right? The Fed will be more long-term for sure. But speaking of, Michelle Bowman tapped as the Federal Reserve's top regulator. What are your thoughts on that? Would that open the door to sort of less regulation for banks? And is that a good idea?
That's an interesting question. Certainly no surprise. I mean, Mickey is the one person on the board today who has the experience and the capability to do that job. So no surprise that he chose her. And I think in general, she would be, sort of in favor of less regulation that is impeding community banks. Where I don't know how that'll happen is how she will parse the difference between regulation of large banks and regulation of the smaller banks. And I think this is the first time there is an opportunity to see a real difference in the level of regulatory burden that is borne by the smaller banks as opposed to the larger banks.
So if you
I think she will definitely not be in favor of reduced capital requirements for large systemically important institutions.
Okay, got it. If you are the head of a mid-sized bank, something that straddles the small banks and the big banks, what does that mean to you in terms of how you build out your business, how you expand your footprint or not, or ramp up what you're doing?
Yeah, the unfortunate case for the mid-sized banks is if you look at the problems we had last year, 2 years ago, it was all in these mid-sized banks. And so they're going to still see quite a bit of heavy supervision, not so much the regulatory side, but heavy supervision of the risks that they're taking. And at the same time, you don't have the scale to really come up with the internal control systems that they have in some of the large banks.
Yeah, puts them in a difficult position then, kind of squeezed from both sides. Betsy, always appreciate your joining us. Thank you so much. Betsy Duke is a former Fed governor and, of course, a former chair at Wells Fargo as well. Coming up on the close, the FOMC held rates steady, but the distribution of the dot plot, that's the interesting part. For some, it leaves a lot to be desired. We're going to get more insight from Andrew Levin. He's professor of economics at Dartmouth College. This is The Close on Bloomberg.
There's always an unconditional possibility of a recession. The economy is strong overall and has made significant progress toward our goals over the past 2 years. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us. Going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs. Surveys of households and businesses point to heightened uncertainty about the economic outlook. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas. Uncertainty around the changes and their effects on the economic outlook is high.
And just a brief taste of what Fed Chair Jay Powell said this afternoon. Now, when you look at projections for where policymakers see rates headed, the median of the Fed's rates outlook did hold firm. But the updated dot plot showed that several dots for 2025, they moved up compared to the last version in December. Does that signal a hawkish shift with 8 FOMC members seeing 1 or no cuts in 2025 compared to 4 in the December dot plot? Some might say. Joining us now for more on this is Andrew Levin. Andrew is a former special advisor to the Fed, and he is currently a professor of economics at Dartmouth. Andrew, good to speak with you. We credit you often as the inventor of the dot plot, which at one point was, kind of an academic exercise, but certainly became something more, especially as the Fed began to lift off. I want to get a sense from you as to how useful you find the latest SEP and the rates outlook from the Fed members when it's clear that so much is unknown.
Well, there is a lot of uncertainty. It's true. But ideally, the Fed has a strategy, and they explain that strategy to the public. And I think one of the things that's been difficult in many cases, ever since the pandemic, really, is it's hard to see the Fed's strategy. So just to be concrete, a couple of years ago, Fed Chair Powell emphasized that they were looking at supercore inflation, which was the service component excluding shelter, excluding rent. That supercore component is still running at 4% today. Mm. So that doesn't seem to be the progress in inflation they were looking for. I think they got lucky that goods prices fell more. Now goods prices are starting to head back up, and not just because of the tariffs, probably just a natural rebound in goods prices. And so I think the extent to which the dot plot's showing you that a number of Fed officials are getting uneasy, that inflation's not making the progress that they really need to see. Maybe they need to have a flat policy from here for quite a while. Maybe they're going to have to even raise rates a bit. It's critical to get back to price stability.
Can you do that with the uncertainty about transitory inflation from tariffs?
Well, we've gone from an acute problem a couple of years ago when inflation was really high and it was just obvious to everyone. Now I would call it a chronic problem. And so as Chair Powell said today, there's not an urgency that they got to slam on the brakes. But they can't leave inflation up at 3 or 4%. That's just not consistent with what the Congress asked them to do, which is foster price stability. Now, the reality here is Chair Powell's, now in the last year of his term. So his ability to make significant changes or to lay out a new strategy is difficult. So unfortunately, I think for the American public, this might have to wait 12, 13 more months until his successor is ready to take the lead in clarifying the Fed's strategy.
Okay, so the forecast that they gave when it comes to GDP, inflation, and unemployment, it leans kind of stagflation-y, and the dot plot kind of leans hawkish. Yet you look at what happened in markets today. Stocks went flying higher, yields came down, the dollar paired some of its gain. Gold was higher, so that's kind of a different story. But what was it about what Chair Powell said during the news conference that provided so much relief to investors? Because to me, it felt like he didn't say much of anything.
Well, I guess there's some art, for some Fed officials at least, to say words without actually clarifying very much. I think the truth is Fed leadership need to be like a family doctor and explain to the public and to the markets and to ordinary people and businesses what the Fed's planning to do. And so there's some times when the physician has to say, look, we just need to wait a little bit longer for some more information. I don't think that's unreasonable. We hope that in the end, the U.S. economy will stay strong. We hope that that to the extent to which these tariffs stay in place, that they're not going to all be passed through. The economy is competitive, and so some of those tariffs won't be passed through. Some of them could cause spillovers to other sectors. The bottom line here is that the traded goods the U.S. imports is only about 10% of the economy. And the part that's coming from those trading partners is a small fraction of that. So the real inflation problem today is not because of tariffs. It's the core services that Chair Powell emphasized 2 years ago. That's really what the Fed should be focusing on. That's how they should explain to the patient and the patient's family. There's still a chronic problem here, and we need to make sure that we get the patient back to full health.
20 seconds, Andrew. Where would your dot be?
I think that they should leave rates where they are. And I think, answering your other question, I think the market's probably relieved the Fed still thinks that it's going to be able to cut rates, not just this year, but by a whole percentage point or more over the next year and a half. That's pretty good news. But the problem for the family doctor is it's not always easy to say, gee, we're going to have to be careful here before we push ahead too far.
Andrew, it's always a pleasure. Really great to get your perspective. Thank you so much, Andrew Levin, Professor of Economics at Dartmouth College. All right, coming up, we're going to speak to Dennis Lockhart, former Atlanta Fed president, about his take on today's decision by the central bank. Also going to dig into what we consider good cuts versus bad cuts. Mohamed El-Erian raised that this morning, and we'll kind of break that down a little bit as well.
A cut's a cut, isn't it?
But why? Is it falling inflation or is it falling growth? And does that actually wind up making a difference? And just to reiterate where we settled out here, the S&P at its best Fed day since 2022, ending up by 1 full percentage point. This is Bloomberg. The Fed holds rates steady, telegraphing expectations, though, for slower economic growth and higher inflation. Bloomberg opinion columnist Mohamed El-Erian, before the Fed decision, had one message for the Fed's path forward.
Communicate in a way that convinces people that you will have the possibility of rate cuts, not because inflation is coming down, the so-called good news cuts, but because growth is problematic, bad news cuts. They can no longer maintain that we don't speculate, we don't guess on policies. They have got to take a view.
All right, let's get more on this with Dennis Lockhart, former president and CEO of the Federal Reserve Bank of Atlanta. Great to get your perspective, Dennis. Thanks for joining. You got 9 policymakers penciling in 2 cuts. Are those the good cuts or the bad cuts?
Who knows? I think the individuals who submitted their projections could have quite different assumptions about the trajectory of the economy. I think what's noteworthy in the dots is that the committee overall swung to a net hawkish view, probably a short-term view, but nonetheless hawkish, 9 at 2 and 8 at 1 or fewer cuts. So that's a bit of a change in the distribution from the December SEP.
Where do you think Jay Powell lands on that? What is his position? And because when he spoke in the news conference, a lot of people walked away thinking that was more dovish than we thought.
Well, I took note of one comment he made, that there's a certain amount of inertia, particularly at this time of year, in making projections. So because there's so much time ahead of us between now and year end, and given the uncertainty and everything going on, he was suggesting that some participants just decided to stand pat and not make a big change. So your question is, where was he in December? Where is he today? I guess I would expect him to be among the 2-cut group or 1-cut group, but certainly not one of the outliers.
Dennis, what really confuses me is how those in the Fed look at soft data. So it feels like at one point, the University of Michigan sentiment survey was mentioned as something that sort of swayed the committee, or the committee thought about when it came to inflation expectations. We got a terrible read last week, and yes, it felt like Jay Powell was kind of brushing it off. Can you just give me some insight into how that works?
Well, it's the University of Michigan survey is about inflation expectations and consumer sentiment, and particularly they focus on inflation expectations. But it's not the only survey. The New York Fed has a survey, did not show the same kind of deterioration in sentiment that the University of Michigan survey did. Some members of the committee put a lot of weight on market indicated inflation expectations, particularly the Treasury inflation protected securities. So they have a variety of indicators, and some came in after the University of Michigan surveys. So I think when they look at the totality of it, they calm down a little bit about reaction to University of Michigan.
But when you dismiss the soft data and say that you need to wait for the hard data to really show what's happening in the economy, and the hard data for now is pretty good, doesn't that necessarily put the Fed behind the curve when things turn?
If things turn quickly, they could be behind the curve. I would argue this is sort of a step back answer to your question, but in my experience, at least, the Fed sort of has an inbuilt behind the curve bias, because you have to wait for the accumulation of data over a period of time to be convinced that you're looking at something real and something that is a real trend. And that waiting for data accumulation, has a tendency to put you behind the curve if there is a shock to the economy. And this tariff-induced inflation could look like a shock.
Do you agree that the tariff inflation could be transitory? I'm surmising from what Powell was talking about. Do you think that's true?
Well, it was interesting that he said it's their base case. It may be their base case, but they don't want to be caught in another transitory rhetorical trap like they were earlier in the inflation cycle. So do I think it's plausible? It depends on what happens on April 2nd, what the numbers look like, how other countries react, whether there are negotiations that happen quickly, whether then there are adjustments. It's possible that the price impact is not as serious as we expect. I thought Andrew Levin made a really good point that the import-export sector is not the economy. It's not the whole economy. It's a relatively small piece of the economy. And imports from particular countries that could get hit with high tariffs are an even smaller sample of that. So I thought Andrew made a very good point that this might not be as dramatic as we expected.
All right, but in the meantime, it certainly sucks up a lot of the oxygen, and kind of everyone's obsessing over it because it just puts this cloud over sentiment because no one knows what's going to happen. I want to get to the tweaking of the balance sheet reduction, the quantitative tightening. The Fed decided to slow down that reduction effort, and Chris Waller, the Fed governor, dissented on that decision. The decision, by the way, of course, is to avoid hiccups in the overnight lending markets like we've seen in the past, as well as to avoid interfering with the upcoming debt ceiling deadline. Are we making a big deal out of this? Is this something that will affect sentiment or affect decisions, or is this just very technical?
I think it's very technical. And I think Waller's dissent is probably based on technical matters. He probably believes there's more room to shrink the balance sheet before slowing down. Obviously, the committee overall thinks it's a convenient time or a good time to slow the pace of things as they get closer and closer to a stopping point. But it's really meant to be a back burner kind of activity and issue, and I just think way too much could be made of it.
All right, good stuff. Dennis, thank you so much for putting some perspective around the news that we got today. Dennis Lockhart is a former president of the Atlanta Fed, joining us there. And if you look at markets today, I mean, there was clearly relief, Alex, certainly for the risk assets, right? The S&P 500 soaring up more than 1%. It came well off its highs, but still, that is a big gain, especially on a Fed day, given what we've seen of late, especially when the Fed made changes to its forecast that suggest that, the economy won't grow as fast as they once thought.
That definitely led a line straight to the stagflation kind of scenario, right? Citi is also estimating that $4.5 trillion of open interest across equities are going to expire next week as well. So you have to wonder, too, kind of any repositioning as we get into that, when April 2nd is still going to be that deadline where we think things may happen, that you may have to readjust your portfolio. So now we just kind of wait and see and get through it.
Yeah, that's the big day that's coming up, April 2nd, when those reciprocal tariffs go into effect. This is The Close on Bloomberg.
Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment.
Fed Chair Jay Powell there highlighting a slowing in consumer spending. For more on how the Fed's decision today will impact individual investors, let's go now to Farnoosh Torah. She is host of the So Money podcast to help us look at this from a personal finance lens. Farnoosh, thank you so much for joining us. Markets took the announcement from the Fed and the press conference as a bullish signal, right? Because he basically said we're at a place where we can cut or we can hold, and there was no mention of the word hike. Is that how you read it?
What I read was that things are very uncertain right now. And I think that the prudent move is to not make a knee-jerk reaction. I mean, I think it was a smart move that we have to still kind of wait and see what happens. It's too early to decide whether we're in a market where we can absorb a rate hike or a rate drop. Similar to how we deal with our personal finances, when times are uncertain, the last thing you want to do is make a knee-jerk reaction that would have ripple effects. And had the Fed raised rates or lowered rates, we would have seen a much different market reaction, I think.
I love that you brought that up, Farnoosh, because you're taking a look at, say, the 401k wealth effect over the last few weeks, which has been pretty dramatic. And I'm wondering what the read-through is for personal finance, like what the sentiment then becomes.
Well, often in the industry and when we're working with people with their personal finances, we tend to say, it's important to stay the course, that news is important, but one day's worth of news or even one quarter's worth of news, it shouldn't inform your entire strategy, and that, the market does move through cycles. I will say, though, there is some chatter for those who are approaching retirement or in retirement, and they have been heavily invested in equities, and that's been fruitful for them. They are taking a re-examination re-examination of that strategy. We're seeing at this anecdotally in conversations with wealth advisors. It's been reported in the news now, where some investors who are in retirement or very close to it are a little they are making moves in reaction to the uncertainty, and their move is to get a little bit out of their equity positions and into sort of more safer havens, bonds, fixed income, because they want to preserve the gains that they have benefited from over the last, the life cycle of their portfolios.
Yeah, especially after 2 years in which the S&P 500 rose by double-digit percentages as well. I want to get your take on savings, those who save and those who borrow, because if the Fed were to cut rates, and right now we're still in a rate cutting cycle that's on pause because there's no mention of a hike here, we may get a replay of what happened last year, which is the Fed cuts rates and then banks cut their deposit rates, but rates on mortgages and other loans tend to stay fairly high. So in the end, that means both savers and borrowers end up feeling pretty squeezed, like they didn't get the benefit of any of it.
Yeah, it depends on what kind of consumer you are. If you're a consumer who is leaning more towards relying on debt and consumer debt specifically, like credit cards, then I think now is an opportunity for you to really come up with, if you haven't already, a more a clear path to getting out of debt before the next rate decision, which is in May. That doesn't give us a lot of runway, but 2 months, 2 payment cycles could make a real difference in terms of, how much interest you pay. So if you are that consumer who is leaning more on consumer debt right now to manage your finances, this is an opportunity for you to really hone in on how you're going to get out of that debt, because there's a likelihood that the interest rates could go up this year. We don't know. For those who are more of the savers, I would say still lean into the high yield savings accounts. We have seen, even with rate drops over the last 6 months, that the high yields have been pretty resilient. And even if we do see interest rates, waver this year, I think we're going to see that market stay pretty consistent with the rates that they've been offering their consumers. I often see high yield savings accounts as the sort of the first level. It's like the sort of the carrot to get the consumer into that bank, and then exploring all the other financial products.
Yeah, I definitely am. The Marcus account has not decreased its rate in a while. So to your point, before we let you go, there was some interesting news, Farnoosh, about a firm actually now being taken into account through your Experian credit rating. So the buy now, pay later can now be used on your credit score. I'm probably throwing this at you right now, but how are consumer credit scores? Is that a good thing to start building up credit for people?
I think if you look at the explosion of buy now, pay later programs, the adoption has been very quick, and it's a booming industry that I think for a long time consumer advocates were upset that there wasn't enough regulation in that market, or at least there wasn't any upside for those who take on this sort of financing and they pay it off on time. It doesn't help your credit. It could hurt your credit. And so now I like seeing sort of the evening of the playing field. So however you end up handling these buy now, pay later plans as a consumer, there will be sort of a result for you on your credit report, good or bad, depending on how you use it. Buy now, pay later plans, it is essentially an extension of credit. So I think it makes sense that we get to either win or lose on the credit side when we take these on.
Yeah, too scared. All right, Farnoosh, thanks a lot. Really good to catch up. Farnoosh Torah, host of the So Money podcast, really influential in the personal finance space. All right, still ahead, what investors need to watch over for the next 24 hours. We got FedEx, we got Nike. As someone said today in the meeting, Nike is the world. Represents lots of different parts.
I think you said that, Alex.
Did I?
I don't think I did.
I think it was
you did.
Oh, okay, whatever. Trade, it's retail, it's global. We got you covered. This is Bloomberg.
FedEx shares getting a tough start to the year as the company faces uncertainty around tariff policy and, of course, weakening consumer demand as well. So as a result, the company expected to reduce its annual outlook when it reports third quarter results tomorrow. For more now, let's go to Bloomberg's Chester Dawson. Chester, good to speak with you again. Let me just start off with this idea that FedEx already in December cut its full year outlook. So why are analysts convinced that it's going to do so again? That's pretty rapidly. There's not a lot of time between December and now.
That's right. Yeah, it is relatively soon after that. It seems like analysts expect them to do that. Obviously, it's not a sure thing. We'll have to tune in tomorrow to find out what they do. But the idea is that there's increasing headwinds, everything from the threat of tariffs to lower use by manufacturing clients, business clients, to the everyday consumer who may be cutting back a bit on sending things, getting there maybe a little less quickly by using a discounter. So all these things in combination have given at least some analysts fear that they may have to cut again before, at least for the full fiscal year that's through May.
So when we look at the potentially FedEx tariff exposure, then you also have consumer exposure and then manufacturing exposure. How are you going to be looking at those three prongs?
Yeah, I mean, they're all fairly equally weighted. I guess the good news is that the company has seen and is expected to see in the most recent quarter a little bit of a pull ahead where companies and maybe even individuals, knowing that the threat of tariffs is looming, moved up some business. So it could well be that for the most recent quarter, they actually did better than expected. But the concern will be, does that mean that everything they're pulling forward is going to leave a big void in the coming months? So that, it's such a big unknown for so much of corporate America and obviously the end user too. It's a little hard to know exactly what it's going to mean for FedEx, but it's probably not a good thing. So I think that's another reason why analysts may be drawing back a little bit in terms of their outlook.
Yeah, reading between those lines is going to be really fascinating. Hey, Chester, thanks a lot. Chester Dawson joining us from Bloomberg. Also, we get earnings out of Nike. As I said earlier, Nike is life or the world, meaning that it has lots of different tentacles. You can learn a lot about the global economy through Nike. Rick Patel is equity research analyst over at Raymond James. He has market perform rating on the shares. What are we expecting when it comes to sales tomorrow?
Yeah, thanks for having me. We are keeping our expectations low on any kind of major upside surprise. We are looking for revenue to be down 11% when they report the quarter tomorrow. And it reflects a function of the company going through a transitional period with its own inventory. They're in the product of a major merchandising evolution. And at the same time, you have a number of macro factors that are coming into play that really raise a lot of questions about where demand is going to shake up. You have consumer confidence is ticking down here. We've had a number of mall-based retailers talk about mall traffic being down. Weather's an issue. So I would keep expectations low for a demand-driven upside surprise tomorrow.
Okay, so there's soft demand trends, and that's not limited to Nike. But is the company, for the things that the company can control, its inventory, its product selection, how it rolls out new products, how's it doing on that front?
They're in the middle innings of turning around their product strategy. So I think in the last few years, they focused way too much on their classic products. So think about Air Force One, Dunk, Air Jordan 1. These are franchises that did very well during COVID. Since the reopening, they have faded in terms of consumer appeal, and the company has not invested enough in running innovation. So as a result, you've seen them lose market share to Hoka, to On. And so in order to combat that, they're in the process of accelerating innovation for some of these critical running categories. And we're not going to really see this, see real traction on this until the fall season. So as you think about this quarter coming up and even the May one, they're still going to be going through this transitional time. And even when the fall product launches, I think it's going to take a while to see if consumers are willing to transact.
In the meantime, how do we learn about inventory and how they're handling discounts?
Yeah, so right now they're in the period of discounting a lot of the legacy classic products that they're looking to offload. For the print that they're going to put up tomorrow, they guided for gross margins to be down 300 to 300 basis points, and that reflects a lot of discounting going on. And I think, that pressure is likely to continue in the fiscal fourth quarter, which is May. And beyond that, you have the concerns of tariffs. For Nike, they source about 17% of their goods from China. So they're going to have to deal with tariffs in addition to dealing with some of this discounting work that they have to work through.
All right, good stuff. Rick Patel over at Raymond James, thank you so much, giving us a preview into Nike's results tomorrow. By the way, Nike shares finishing down 0.4%, even as the overall market rose, so adding to its declines so far this year. In terms of what else we are looking ahead to for markets and investors to focus on over the next 24 hours, it's not just Nike, it's not just FedEx. We've also got Darden Restaurants, Micron, and Lennar reporting.
Well, yeah, that's going to be really interesting as well. Lennar in particular, talk about tariff read-through, right? Like if you can't get lumber from Canada, what does that wind up meaning for the house builders? I was speaking with somebody who basically builds houses, and he was saying that he doesn't know how to source right now. So the construction issue is there. Or you can definitely get like a plumber to come work for you. You can definitely get the supplies, but you got to pay, and the decision has to come really fast.
And you have to find workers too. That's another big issue right now. The tight labor market, especially for the construction industry. All right, we also have the Bank of England decision tomorrow. The UK expected to follow the Fed with a rate pause. Not much movement there. So that's coming up in the morning. And then stateside, more data, Alex.
Well, yeah, but you skipped over. I mean, the Bank of Canada definitely wound up cutting because of tariff risks. You wonder if we're going to wind up hearing that from the BOE. Anyway, yes, we get jobless claims, so only ways looking at that. But it seemed like Jay Powell was feeling okay about the state of the economy, even though they see the employment rate moving higher as well.
He wants to see the hard data. Why not?
Yeah.
All right, existing home sales leading index, 10 a.m. And then we can't forget to mention, have you filled out your bracket?
Oh, no. Okay, I was told by Tom Keene that you were supposed to do it for me and that I would be the sleeper hit of the season.
Oh, is that what he said?
Yes.
All right. Well, March Madness officially kicks off.
You should do that for me.
Well, we'll talk about that later on. You can participate in this year's Bracket for a Cause for March Madness by typing in BRKT into your terminal and clicking on the Make Your Picks function. This is Bloomberg.